September 15th, 2008. A Monday morning. Lehman Brothers files for bankruptcy. It is the largest corporate bankruptcy in American history. The firm has existed for 158 years. By the end of that week, the global financial system is in freefall. AIG, the largest insurance company in the world, requires an $85 billion emergency loan from the Federal Reserve to avoid collapse. Merrill Lynch is acquired by Bank of America in a weekend deal to prevent its failure. Money market funds, which Americans had assumed were safe, begin breaking the buck for the first time since 1971. In the months that follow, the Treasury commits $700 billion to the Troubled Asset Relief Program. The Federal Reserve extends trillions of dollars in emergency lending. The American economy loses 8.7 million jobs. Household wealth drops by $19 trillion between 2007 and 2009. The standard narrative explaining what happened is familiar by now. Subprime mortgages were issued to borrowers who could not afford them. Wall Street packaged those mortgages into securities. Rating agencies gave those securities investment-grade ratings they did not deserve. The housing bubble burst. The securities collapsed. The institutions holding them collapsed with them. All of this is true. None of it is the actual explanation. The subprime narrative describes the trigger. It does not describe the architecture that made the trigger catastrophic. A trigger requires a loaded weapon. The loading happened across decades. The pulling happened in 2007. This is the story of how the weapon was loaded, and why every previous episode in this series has been preparation for understanding what 2008 actually was. To understand 2008 structurally, you have to recognize that 4 separate architectural decisions had to align for the crisis to take its actual shape. The first was the post-1971 monetary architecture. After Nixon closed the gold window, the United States dollar became a fiat currency whose supply could be expanded by central bank policy. The decades that followed saw repeated cycles of monetary expansion, most aggressively after the 2001 recession, when the Federal Reserve cut interest rates to 1% and held them there. The cheap money produced by that expansion had to go somewhere. A significant portion of it went into housing. This is what created the conditions for the housing bubble in the first place. Not greed, not bad lending standards alone. The structural reality that the post-1971 monetary system produces asset price inflation that has to find an outlet, and that the early 2000s outlet was American real estate. Housing prices nationally rose by approximately 88% between 2000 and 2006, a pace with no historical parallel since the Federal Reserve began tracking the data. The second architectural decision was the 1986 tax architecture. Post-Tax Reform Act, the distinction between earned income and owned income widened. Real estate in particular became a powerful tax shelter through depreciation deductions, mortgage interest deductibility on multiple properties, and capital gains treatment on sales. The tax code made owning property dramatically more attractive than earning wages, which channeled both individual and institutional capital into real estate at scale. The third architectural decision was the 1999 repeal of Glass-Steagall. Once commercial banks could own investment banking subsidiaries, the deposits of ordinary Americans could be used as collateral for speculative activity on a scale that pre-1999 law had prohibited. Citigroup, J.P. Morgan Chase, Bank of America, Institutions that combined consumer banking with investment speculation became the primary vehicles through which subprime mortgages were originated, packaged into securities, and sold to global investors. The fourth architectural decision was the Commodity Futures Modernization Act of 2000. This is the piece that gets less attention than it deserves. Signed by President Clinton in his final weeks in office, the law specifically exempted over-the-counter derivatives, including credit default swaps, from regulation by either the Commodity Futures Trading Commission or the Securities and Exchange Commission. The credit default swap market, which had been small and tightly regulated before 2000, grew to a notional value exceeding $60 trillion by 2007. That market was, by design, opaque, unregulated, and concentrated in a handful of institutions, including AIG. Each of these four architectural pieces was a deliberate policy choice made under specific political conditions, sold with specific public justifications, and passed with specific bipartisan support. Each of them, in isolation, was defended as modernization or reform or efficiency. Together, they assembled an architecture in which catastrophic failure was not a possibility, but a structural consequence. The mechanics of how the assembled architecture produced the crisis are now well documented. Cheap money from the post-1971 monetary system flooded into housing. Tax incentives from the post-1986 architecture amplified that flow. Integrated financial institutions made possible by the 1999 repeal originated subprime mortgages, packaged them into mortgage-backed securities, and sold them globally. Unregulated credit default swaps, made possible by the 2000 exemption, were written against those securities by AIG and others, creating the appearance of insurance against the risk. When housing prices stopped rising in 2006 and began falling in 2007, the entire structure cascaded. The securities lost value. The insurance against the securities turned out to be uncollectible because the insurers were undercapitalized. The institutions holding both the securities and the insurance discovered they were insolvent. The Federal Reserve and the Treasury intervened on a scale unprecedented in American economic history. They did so not because Lehman or AIG or Citigroup deserved rescue, but because the alternative, letting integrated financial institutions whose failure would propagate through the entire economy actually fail, was politically and economically intolerable. This is the meaning of the phrase, too big to fail. It is not a description of corporate behavior. It is a description of the architecture that made certain institutions impossible to let fail without catastrophic consequences for everyone else. The post-crisis political response was the Dodd-Frank Act of 2010. It ran to over 2,300 pages. It created new regulatory bodies, imposed new capital requirements, mandated stress tests, and gave regulators new authorities. What it did not do, across thousands of pages of detailed legislation, was reverse any of the four architectural decisions that had made the crisis possible. The post-1971 monetary system remains in place. The tax architecture from 1986 remains in place. Glass-Steagall has not been restored. The credit default swap market has been brought partially into regulated clearing, but remains structurally unchanged. The institutions that were too big to fail in 2008 are larger in 2026 than they were in 2008. JP Morgan Chase has grown from approximately $1.6 trillion in assets to over $4 trillion. Bank of America, including the Merrill Lynch acquisition, has expanded similarly. The concentration that made the crisis catastrophic has intensified, not diminished. This is the structural truth that the standard 2008 narrative obscures. The crisis was not a market failure to be corrected by better regulation. It was the predictable output of an architecture that had been deliberately assembled across 4 decades. The post-crisis reforms address the symptoms while leaving the architecture intact. The next crisis, when it arrives, will originate in the same structural conditions because those conditions have not been changed. Understanding 2008 changes how you read every subsequent piece of financial news. It explains why the 2020 pandemic produced asset price inflation rather than depression. It explains why interest rates have moved within a narrow range despite massive monetary expansion. It explains why wages remain stagnant while housing, equities, and other assets continue to climb. It explains why every administration since 2008 has tinkered with the architecture rather than dismantled it. And it explains why this series began with 1913 and has worked forward through 1971, 1978, 1986, and 1999 to reach 2008. Each episode is not a separate historical event. Each one is a piece of an architecture that, when assembled, produces predictable outcomes. Concentration of wealth at the top, stagnation of wages at the median, escalating asset prices, periodic, catastrophic failures absorbed by public balance sheets, and recurring crises that leave the underlying structure intact. The 2008 financial crisis was the most visible failure of the architecture so far. It was not the last. The conditions that produced it have not been corrected. They have been extended, deepened, and made permanent. Next week, the architecture in its current form, not a single year. The full picture of what the previous 6 episodes have actually been describing, assembled into the financial system you are living inside right now, and what it means for the decisions you make about money, work, and time. Subscribe. You are going to want to see it.